Welcome everyone. My name is Kamal Manocha. Today we have Mr. Manish Bhandari from Vallum Capital, and the topic for today's webinar is very interesting. We have seen over, I would say, at least my last 2 decades of experience, that whether it be businesses or it be various assets, there are always cycles, and these cycles lead to euphoria in valuations and pessimism in valuations. And to catch a cycle right is a determinant of how much alpha a fund manager is able to generate. Vallum Capital has been managing money for public for last more than 1 decade and has been generating alpha. And I'm sure they have been able to assess, kind of the level at which particular cycle is playing correctly. And that's hence the context of today's webinar, to understand how to kind of assess at what level are we at present in terms of cycles of various businesses, various sectors, various assets, and how does valuations look across all these attributes. And we have an expert who, as I said, has been managing money for public for last more than 1 decade, and otherwise he brings with him more than 2 decades of experience having managed money in capital markets. So without taking much time, I will hand it over to you, Manish. First of all, a warm welcome to our platform. PMSAF World was set up 4 years ago to bring in speakers like you to talk to our audience and give kind of, I would say, positioning of your respective portfolio and approach for investors to actually make a well-informed investment decision, while kind of allocating their money. And we have been doing webinar every Friday, and this kind of process has been kind of liked and appreciated by a lot of savvy investors. So in the first half of this conversation, you will be giving your presentation, followed by which I have some questions that we have received from our clients, as well as I kind of welcome everyone who is part of this webinar to send us questions over chat, and we like to cover all of them post first 30-35 minutes of presentation. I am giving access to you for the presentation that I have uploaded here, and then it will be over to you for the first half.
Thank you, Kamal. Thank you, and very good evening to everyone who has joined this webinar. The topic of our presentation today is the signal and noise from the business cycles. While doing investing, we all are student of observation, what we have on the various data points, and this has helped us and Vallum a lot in terms of while doing the investment. So I chose this topic today, so at least we can share our learnings from the perspective people who want to make a career in the investing field, as well as who are serious investors. So let me take you through what is a business cycle. It's a cycle where there are the asset cycles, there are business cycles for the companies, and a careful study of a business cycle or a sector or either an industry and a business generates lots of observation, and as an investor one could position itself very carefully when there is an up cycle which is upcoming, or at least save their money when there's a down cycle which is going to get started. So I'll take you through this presentation, which will talk about the understanding of the business cycles for various assets and companies, understanding maybe overlay of the how valuation cycles and business cycles of the companies influence each others, and how Vallum did different things at a different point of time by their study of the business cycles, and how Vallum and his clients did benefited out of it. So observation and observing cycles and the pattern is part of the investing. And so there are various cycles which we have observed from the macro point of view, and the asset classes have their cycles. There is a cycle for the US dollar, there is a cycle for the FI outflows, inflows, and there are real estate cycles, and there are many factors which influences each other to finally give an observation pattern to the investors. So let's talk about the US dollar cycle. What has been observed is that the DXY index has got close to a 6.5 to 7.5 year cycles, and this is something what we have observed from 1974 onwards. You have an up cycle and you have a down cycle, and so on a log scale of 30 to 40 years, there are predictable cycles which has happened in in the US DXY index also. So which gives you an idea that these cycles are predictable, partly predictable. If you do some homework, then you know how to position. And what does a US down cycle or a US DXY down cycle means? That the emerging markets are going to benefit, the hard assets are going to benefit. And if I have to look back, what has happened in the last, we have closed 5.5 or 6 years of up cycle for the US dollar, and we have moved into a down cycle for the US dollar. So next 7 or 8 years, we are going to see a down cycle for the US dollar. And as I mentioned, the emerging markets, hard assets, the currencies, emerging market currencies are going to benefit substantially from the US dollar down cycle, and which positions India also attractively when we talk about from this variable point of view. Also look at it. There are US 10-year treasury cycles, and that influences the FI inflows and outflows. And it's a very busy slide, but it gives you some idea that whenever there is a strong, the interest rate cycles have gone up, then the FIs have been there has been a net outflows. And if the cycle has gone down, if there is a yield which has gone down, then there is a net inflow into. And we have taken India as an example. If I have to extrapolate this example to the various other emerging markets, then I'm sure that this number will change also and will show a similar pattern. So this gives you an idea about that even the bigger asset classes have got the cycles. The money also moves in cycles. And look at this. This is another fund flow cycle which has happened. So this is the indexation of the China index as well as the Indian indices. And China did followed a zero COVID policy, and in that context, in last 2.5 years, India did benefited substantially versus the China, and India gave a close to 59% return versus the China close to 13.5%. And post the China reopening, the cycle changed, fundamental change, and the cycle changed, and the China has given a close to 5.5% return versus India minus 3.5% return. So close to 23rd December or so. So this brings me to a point that we do observe various cycles in various way or others, and all these cycles do influences our choices of our asset classes, our choices of individual stocks in some way or other. And this helps you to think a lot in terms of how to observe a pattern in the cycle, This was very interesting cycle we observed at Vallum, that the negative real interest rate, where the inflation was significantly higher than the interest rate in the economy, and this is a chart for India, did produced a flat return for real estate. And preceding to it, there was a negative real interest rate cycle, which produced a superlative return for the real estate cycle. And as the cycle changed between 2014 to 2017-18, the real interest rate cycle changed. The housing prices did flatten out for close to 5 to 6 years. So observing this cycle helps you in positioning on the various sectors and the companies from a top-down perspective in the process. And this has helped us a lot. We wrote about a very detailed report in 2013 and 14 that the end game of the speculation of the Indian real estate has begun, because there was a negative interest rate cycle for pretty long period of time, for 3 or 4 years, which did produce a superlative cycles in the Indian real estate. And then thereafter, the cycle change, the interest rate cycle change, which did produce a flat return for the real estate. So a lot of people got stuck up on the wrong side of the tail on the real estate cycle, and it took them 7 or 8 years of value destruction before they could make up any change in the process. So let's come down to the understanding of the business cycles and how they impact the companies also. Now, I have taken a few very basic examples on understanding the business cycle. Just look at the GNPA, gross NPA and the PSU Bank, and we have taken SBI as an example, and gold and the Muthoot Finance, and how LNG and oil did influence the Indraprastha gas. Most of these companies have been part of our portfolio, and we did use this cycle analysis while making those bigger bets and the investments. If I have to look at it, the gross NPAs for the PSU banking system as a whole did saw elevation from 2015 to 2018 and 19. And from there onwards, the cycle changed significantly as we moved on to 2022 and 23. So how do you position yourself? There was a return which was a flat return between when the cycle was significantly in acceleration path between 2015 to 2018-19, and thereafter the cycle did change. So what it requires from the investor is that one need to figure out that where we are in the cycle, and some careful research do give you an idea about that we are on the peak of the cycle, and from there the situation is going to change positively. And if you look at the return of the underlying stock, it did change dramatically from positively in the process. So one could be sitting from 2015 onwards, while if you come and join the party in 2018, 19, or 20 onwards, the return can change substantially by understanding of these cycles. Another interesting company was Muthoot Finance, which is a gold loan company. For some of you, if you have not heard of this, and this get influenced by what happens to the gold prices. And look at a predictable pattern. If the gold prices has gone down, the Muthoot Finance has also gone down substantially. And when the gold prices went up, so a careful analysis of the gold cycle and upcoming gold cycle would have been a levered bet on this company, and underlying understanding of the cycle did help you in generating a superlative returns in the process. So this gives you again an idea about that understanding cycles or the variables for the earnings of the businesses do help a lot, and these cycles, the mega cycles, do help you in positioning yourself. And there's another interesting example of Indraprastha Gas, where this company gets influenced by what happens to the LNG price, partially influenced, and we have taken oil as an proxy to give you an idea about the cycle, underlying cycle. And if the oil prices has gone down, the Indraprastha Gas has done phenomenally well. And if the oil prices has gone up, then the stock has produced a flatter returns in the process. So there is a relationship, seesaw relationship between the oil prices, which is also a proxy to me at this point of time of the LNG prices. But there are a few caveats one has to understand when you're looking at these cycles. What are the outcomes of these business cycles? The outcome of investing in a business cycle or looking through the lens of a business cycle is that you require a deeper domain knowledge of that industry, because you're going a counter cyclical in the process. And usually stock reacts with leads and lags. When you're making a stock investment, they usually react with leads and lags in the process when you're doing this business cycle investing. Also, investor is entering into a lesser crowded trade and is picking up a lot of unpopular ideas. So it requires a lot more courage and conviction to do these kind of trades. And there your understanding of the cycle comes into play. And usually one has to keep a minimum horizon of 2 to 3 years before you can see a superlative outcomes, because cycle, it takes long time for cycle to change. It doesn't change it overnight. It doesn't change it in 3 months. And usually the change of the cycle is met with a lot of skepticisms. And one of the interesting the interesting aspect of this strategy is that investor can expect a lower drawdown by such strategy, because the earnings of the companies are not reflecting. The future of earnings will take some time to reflect the change in the business cycles, and you are appropriately positioned in the process where it is not a very crowded trade or a momentum trade in the process. Now let's understand a very interesting aspect. How does the valuation influences the business cycles, the earning cycles? Do they feed in each other or not, or they are mutually exclusive to one another? We have taken an example of an Eicher motor, and the outcome for the two case studies what I'm talking about to you today is that the acceleration of earning cycle also helps in the expansion of the valuation multiples. So there are two periods, 2012 to 2014 and 15, while the stock did 718% growth on the stock price, while the EPS grew by shade less than 200%. And so there was a P multiple expansion. And if you look at the period between 2017 to 2020-21, the stock did corrected by 56%. Why? Because there was a flat EPS and the P multiple did shine. So these two examples, apart from Eicher Motor or Page Industry, is giving you an idea that usually the investor would do a momentum investing, or the P multiple will also expand when the earnings are expanding, or earnings are expanding or accelerating significantly. So you have to be cognizant of the fact that if you are investing in this kind of cycle, or if you're caught on the other side of the cycle, where the earnings will go for in future for a decline or a tailwind, or earning tailwind will be a headwinds, then you're going to see shrinkages of the P multiples also in the process. And very contrary to the fact what I was talking about is, if you are looking at the business cycle, which is the start of a business cycle, or start of the earning cycle, or business cycle influencing the earning cycles, then you are going to see the P multiple expansions also, or multiple expansions also, whether P or EV by EBITDA multiple. In a nutshell, the multiple expansion also, and which will be in your favor as an investor. So understanding the cycles and how cycles are influencing the valuation cycle is a very interesting and important aspect while doing the investing. This is an interesting slide which I keep on reminding to my team, and as I've gone through this journey in the last 2 decades, as Kamal was mentioning, is that most of the sectors which have become overvalued and did well for some period of time, they have gone through a huge valuation upside and earning as well as the valuation upside cycles. And if you look at this chart, which is from 2000, you had a technology boom and burst, which then followed by engineering and logistic boom and burst, then a construction and telecommunication boom and burst in 2008, and very noticeably the pharmaceutical boom and burst in 2014 and 15. And my experience suggests that it usually takes 7 and 8 years for this business cycle and the valuation cycle to change, and for most of the companies to regain what was there in the preceding peaks. So pharmaceutical industry would have taken some 6-7 years before they regain the similar market caps. So that is the kind of value destruction which can happen if you would have invested in the upper end of the cycles. So investing is not all about just finding the good companies. It is also about avoiding the overvalued sectors in some way or other. This chart gives you an idea about, this table gives you an idea about that how many years it has taken. It's just an indicative purpose, that how many years it has taken for the valuations to see their peak back again. In some way or other, companies go for mergers, and so many changes happens on the corporate structure side. But on an average, it takes 7 or 8 years on the valuation cycle if you are caught on the, and if there is a headwind, sustained headwinds on those valuation cycles and the business earning cycles. So you have, in a nutshell, you have the contraction of the earning multiples, as well as your contraction of the earnings, which finally did produces very inferior returns over a period of time in the process if you have bought an overvalued sector. How Vallum has taken a very differentiated investment decisions over a period of time, 2 or 3 noticeable. One in 2013, as I mentioned to you, we were able to see the real estate upcycle, and the coming debacle of the real estate upcycle after 4 and 5 years of huge expansion in the underlying asset quality. So that gave us enough courage to see the dislocation in the PSU banking sector, because most of these banks were owning the real estate as an underlying while giving the loans, whether it is the term loan as well as a working capital loan. And we do write a shareholder letters, which we spoke about this in detail about this. And something similar did happen in 2019, where there was a depreciation of US dollar cycle, which was the start of a US dollar cycle. This was just slightly before the COVID, and the rise of the gold prices, and we were able to capitalize on this by making a suitable investments in the process. And same was the case in 2019-20, where after 7 or 8 years of value correction in the pharmaceutical sector, a few pockets were giving a very good interesting opportunities in the process. So most of these investments were done by keeping in mind the business cycles in mind, and making those investments, the bigger calls, by taking the calls on the business cycles. Very contrary view we did spoke about on the chemical sector when the world was gung-ho about the chemical sector. So I did mention about this in November 2021, that the chemicals are seeing the expansion of the earnings and the spreads as well as of the valuation. And finally, over a period of time, as the situation normalizes, the chemical sector will see a lot of headwinds in the process. And same was the case on November 2022, not very far away. I did very, very strong case on the realty stocks, which did saw a very strong upturn in the process. And from there onwards, after the inventory liquidations, I didn't found a significant earning expansion corresponding to the valuation expansion what has happened in the process. So all these were reflection of the cycles what we were seeing in various cases, and we were taking a contrary call to those cycles and staying away in the process. Very shortly, what has been the performance of the Vallum strategy what we run for few of you would be keen on. And with this, I end my presentation, Kamal. We are just exactly in time of 30 minutes, what you allocated to us. And thank you. And if there is any question, I'll be more than glad to answer.
Sure, Manish. I think this was very interesting, and this was required at this juncture because markets are in confused state, and investors over last 18 months have kind of tested a lot over their patience because I think none of the strategies is able to generate alpha. Forget alpha. In fact, performance itself is bad. So the foremost question that comes to my mind is that over last, I would say 5 years, the first 2 years was an era where growth stocks were doing quite well. Some of the expensive, high quality businesses have actually delivered great returns. In fact, those stocks did not fall much during the COVID crisis, and that is how they all the more accentuated the returns for investors. But at this juncture, in the current context of macro scenario, where we know interest rates are rising, what's your view over say next 5 years about some of those high quality stocks like Titan Asian Paints, Pidilite, Nestle, TCS, some of these, or Page Industries as you mentioned. So all these high PE stocks.
Kamal, it's so difficult to put everyone in a one basket and say that these set of stocks will do well or not. Maybe some will do very well and some may not do well. But if you are making a case, a generalized case on that, what did well for last 4 or 5 years and whether that will do well in the next 5 years or so. So let's go back in the history of last half a decade, which is not very far away from most of our investors' memory, that you had a record low interest rate cycle. Maybe 22 decade of people have not seen a rise in the interest rate cycle, at least in the US, which people have spoken about. And that's what has happened. The dead whale has come out yesterday in Silicon Valley Bank, where the treasury has created a lot of losses. So usually there is a very interesting saying that when you do a dynamic fishing in the ocean bed, you have the small whales, small fishes which come up first, which was the stage in last 6 months or so, and now you have a bigger dead whale which takes maybe 6 months time frame to come on the surface, which is the SBB yesterday, and then maybe some more banks which is talking about the size of the losses, which is mark to market, right? Which is again a cycle. It's a bond cycle, 20-year, 30-year bond cycle, and interest rate hit a low of as low as 0%, and then it just started reversing, and then every passing day you have a judgment which is talking about a higher accelerated of the earnings. So the last 5 years, when you spoke about the certain set of companies, high growth companies, and I'll include the new age companies did well, it was also reflection of a zero cost of capital. It was reflection of a very lower cost of capital relative to the history of the interest rate, and also relative the negative interest rate cycle. So when you have a relatively a negative interest rate cycle or a zero cost of capital, many of these businesses which produces a far back-ended earnings do usually well, because that's the way you can discount those earnings over a period of time, very long dated point of time. And as the cycle changed, then you have a crossover where the people want have alternatives. People do have an alternatives to reallocate their capital to a better sensible areas of investment, and the hard assets started doing well. And why hard assets do well? The hard assets in a rising interest rate scenario does well. Just look at a situation where anyone who has set up a factory of 1.5 decade back did saw deflation from China and deflation from a interest rate cycles point of view. So the factory, those factories didn't produce a meaningful returns, and the technology improved, and someone can borrow today and set up a interestingly more technological advanced factory. Now when the interest rate cycle changes, all the assets get repriced. So then that's the reason you are seeing a repricing of another set of companies which were not the beneficiary in the last 5 years. Having extrapolated to this situation, I see that the growth basket, which is the so-called growth basket of the yesterday, is going to underperform the set of companies which are going to benefit from the inflationary environment. So we would be very careful in buying a set of companies which could be which have been a beneficiary of the lower interest rate cycle for years and years to come. And but then again, I said it is a cherry pick. It is, maybe we are talking about a basket. Someone will do very well from the basket because individual managerial capability still have an ability to produce a very superlative returns on the earnings side, and that can beat the expectations of many analysts and many investors.
Sure, Manish. I think you have answered question covering all the macro aspects. So, if because this is an important question from the point of view of some of the investors who have started investing in equities over last 5 years. Again, I'm kind of making the question more micro, because many investors today hold positions in stocks like Bajaj Finance, stocks like Nestle, Pidilite, or in mid cap space like Page Industries. So some of these stocks are high PE stocks. I agree, all these are different business models, and we cannot kind of club them together. But the point is, when you say that some of these stocks will underperform, over say next 5 years because now interest rate cycle has turned. So the other argument is that these businesses are not borrowing at all. These businesses are not having any debt in their books. So why would rise in interest rates impact these businesses? In fact, rise in interest rates will impact the competitors of these businesses, and hence these businesses, because they are cash rich, they will be able to increase their market share when their competition will struggle because of the inflationary and high interest environment. So in such a argument, how would you kind of refine your answer to further predict the future of some of these high quality businesses?
Very interesting question, Kamal, and thanks that you asked us about it. Well, it's been bothering in my mind for quite some time, that what has changed in the world in the last 5 years versus the next 5 years. So I'll give you my analogy. I can be completely wrong, but yeah, this is my observation of being in a business for 22 years or so. 5 years back, on Nestle's of the world, it's a wonderful company. It did made a sense to you because the guy who was a holder of Nestle had a competing asset which was a zero coupon bond, which was a negative interest rate cycle. So Nestle globally was able to borrow in a negative interest rate. Austrian government was borrowing you in a negative interest rate environment. So what a holder of Nestle, Nestle India, Nestle globally, or so money is interchangeable. That's the beauty of the financialization in the world. Looking at the currency aspects and everything, was buying a 2% earning yield or a 1% earning yield assets just to protect itself from the further debacle of the interest rate cycles. So you have one set of investors who are buying Nestle's. They were not the Nestle investors; they were the bond investors who were making a crossover into the Nestle's of the world, searching for the yield. Okay, so now Nestle is a huge earning yield story, a dividend yield story of a 0.5% or maybe a 0.25%, but still it was able to protect your capital in some sense or other because it was a positive earning yield story versus a negative callable bonds which was sloshing around in the world. I don't remember number correctly, but it should be close to $22 trillion of negative numbers which was floating around. So those were the investors, and they were ready to buy this Nestle at any point of time. Okay, till it would have gone a negative earning yield in the situation. Now suddenly the situation has changed, and you have a 5% in the U.S. Treasury, 4.5, 5, and many other bonds which will give you a significantly higher number. Are those guys are going to own Nestle's now, or do they want to own Nestle's now, or they want to be compensated for the equity risk what they are taking? At that point of time, they were not getting compensated from the bond, so they were looking at the equity as a risky option. They had a zero cost of capital to provide for, or maybe a very meager return expectations in the process. The world has changed now, so that guy is not going to come back to the Nestle. The shareholder of Nestle is going to change significantly, or that this basket, which was which was attracting a different set of consumers, was attracting a different set of investors, is going to change because the investors' priorities have changed in the process. And if US Treasury is going to give you a 5% yield, your asking compensation from an emerging market is going to be 7.5, 8, 8.5% or so, nothing less than that. So this is a big change which has happened in the world. We all don't see this because we do have this boiling frog syndrome that we will get to know only when there's a big whale dead, which I spoke to you about. $1 trillion of student loan in US, another $1 trillion of credit card loans. Something has to go burst in the process for us to realize that there is a real risk and it's not so easy. Now, you did spoke about that. What an investor should do, I would say, buyer be aware. Investor did came in looking for a linear return from the equity market. Equity market has never produced a linear returns. They give you erratic returns. You stay for 3 years, and year 4 and year 5 give you returns and compensate you for the risk what you have taken. And so if you are looking at that what has happened in the past is going to get extrapolated, answer is no. And that's the reason that one has to be very careful while making equity investments. And that's not cup of tea. And that's the reason a lot of people do keep their money in FD just to have that peace of mind that they want a linear return. So equity market investor has to be cognizant of the fact that equity is not a linear return game. You have a 3 or 4 years. So look at a scenario in 2009 September after the Lehman crisis and normalization to September 2013 before the change in the era in the governance happened in India. You had a zero returns in the equity market on the larger indices, and you had a -9% return on the BSE mid cap indices. These are the reference indices I do look at closely. So 3.5 years of zero return, 4 years of zero return, and then suddenly the return started coming in. So what happens to the investor who comes in 2011, 12? He made a lot of money in real estate. That's okay, but you didn't make money in equity market. So you'll always have these phases where you can't expect a linear returns in the equity market, and you will have a phases where you will have a handful of companies which will give you returns, not a general market which will give you a return.
Sure, Manish. I think well answered. So moving on to the a second question pertaining to the topic of our webinar. You spoke about various cycles. So let's talk about interest rate cycle and where do we stand at present. Quantitative easing as a macro stance started in 2008 after global financial crisis, and it kind of continued for a very long period of time till 2015. And because US was keeping interest rates close to zero from 2008 to 2015. After that, they did try to increase interest rates, but then world was hit with COVID very soon, and they had to change their stance back to the dovish, and they kept the quantitative easing stance. It's only in 2022 that they have started to reverse, and now we are back to close to 5% Federal Reserve rate, which we had seen in 2007. So from here onwards, do you see again this change which has happened from quantitative easing to quantitative tightening to sustain for say 3 year, 5 year, or 10 year? What's your view in terms of this business cycle? Is this a beginning of a new business cycle, or you think this is just a blip and the wheel will turn very soon and interest rates will again be back soon on the downside?
So, Kamal, in my experience, I haven't seen a business cycle changing in a quarter or so. I haven't seen a business cycle changing in 1 year or so. I haven't seen a business cycle changing in 2 years or so. So, there's one interesting pattern which I've shown you the charts. And the interesting pattern, if someone has observed carefully, is that usually those business cycle longs for 3 and 4 years. And you have to be careful enough and smart enough to see that first 2 years have passed. And now I'm moving in the year third, year fourth, and then I see the change in the cycles. Perceptible change in the cycle, or maybe year three or four. And so the interest rate cycle can be long enough. The equity market cycles or the stock cycles or the business cycles can be 3 or 4 years enough or so. But I don't see any situation where the situation can change so dramatically in next 2 quarters or 6 months or a year or so. What is the variable in our hand today is that whether the US will go in recession or not. I think so. There's a meaningless debate today. None of us would have some very different sense on the macro side, on the US recession side. Ideally, after such a wonderful cycle of last decade or so, and expansion of the earnings, ideally any economy would see a recession, and the probability will be significantly higher. Whether the US will cut the interest rate cycle, which they've increased significantly last year, with 425 basis point change in the interest rate cycle was the strongest tightening which has happened by the Federal Reserve in the years and decades to happen. So whether we are going to see that change, I think it will be a pause for some time, because the inflation has become a structural. The reason inflation has become structural is because of the China has set a deflation for 2 decades in the world. China is itself is seeing an inflationary policy, and you'll see the inflation from China because of the wage hikes and the declining population and many other things, and because of the deglobalization what we have seen. So inflation is not going to collapse so easily. And so I don't see a situation where you can you can sense an opportunity where the interest rate cycle globally or the US is going to change so dramatically. Most of the world economy will follow a cycles, except Japan are following a cycle of US. Either you are preceding or with a lead and lags, and so say same is the case with India and other emerging markets. So we are in for a tightened interest rate cycle for some more time here, and that's going to stay for some more time.
Sure. So given this as a macro, stance for at least say next 1.5 years, as you're saying, cycles do not turn soon. What are the top three sectors, that you see from the lens of value? Because I see, you support value style of investing, which fortunately has again been kind of, favorable for markets now after a long period of gap, where growth investing was kind of favorable. And now for next say, couple of years or maybe more than that, if value investing is what will be the, I would say, uh, markets attraction, what are the three top sectors that come to your mind in that context?
Kamal, I would bucket ourselves as a growth at a reasonable price. We are not momentum, we are not deep cyclical values in the process. We are a growth at a reasonable price. That is all our style of investment, which is closer to our style of investments. Value has done well in some parts, and well, more the growth, high growth investing did well, and every style has got its own time frame and shades when they do well or so. Uh, the most important idea for the investment manager is to find a superior risk adjusted returns. Any style what you follow over a long cycle of time. So I can leave you with one sector, not three, but one sector, which I think which will do well, looking at the macroeconomic context, what is happening globally, as well as what is happening in the Asian markets, as well as flowing down to the Indian domestic market or so. One area which I would see having a lot of promises where the time has come now is the industrial consumables. So when I see what has happened, and after a long time, the industrial cycle is recovering in patches, the PLI scheme is going to accelerate this recovery significantly. So industrial consumable is one sector which will do far better than the other relative sectors in the process.
Sure. So can you please elaborate, industrial consumables with some example of a business? We know that, we cannot talk about stocks and nothing to be construed by anybody in the audience as any kind of investment advice, but just for learning purposes, one business that comes to your mind, which is supporting the sector that you are confident about.
Sure. So it's easy. I'm sure your audience is well versed on the investing side. So industrial consumer. So you have a capex cycles, long dated capex cycles. You have a consumables which goes into those capex cycles in the process. So you have a one part. So there are various phases which gets played into when the industrial revival happens. The first cycle is with the capex, long dated capex, heavy equipment, machineries or so, and then the cycle changes, and then it is more consumables which goes in the process, and that's the area which I'm talking about, where I'm particularly looking at industrial consumables as the next bigger bets, which will ideally should happen in the process of money making process.
Sure. And otherwise, if we talk about Nifty 50 or Nifty 500, the top sector today, as we see, is financial services with 30 and 35% weights respectively. And then the sector that we see is IT. Then third is consumers, and then all others are the low weight sectors. If you were to kind of, because of your last more than 2 decades of experience of having studied cycles, now I'm talking about trying to understand the bigger picture, the long term possibilities. If you were to kind of predict India in 2030 or capital markets in 2030, how do you see these weights in Nifty 50 and Nifty 500 across all these sectors?
Very difficult. I haven't thought in putting bets in a similar way. uh, I would say that the bigger bets today, from a cycle perspective, need to be put on the pharmaceuticals, where the big value destruction has already happened, and the business has got far more real values in the process than what has been administered today or reflected on the quotations. So that is one area which I would say. At some point of time, chemical sector will become equally attractive. Not at this point of time, at some point of time. And these are the areas where you have a global strengths, and the companies are putting up a global scales. Incremental return on capital employed are going to be far superior from what we have seen for some set of companies. So I would say I would think in the silos, and in those silos, such sectors would come up over top of my mind, rather than weighting the indices, because indices get influenced by one heavyweight or two heavyweight, and you have a lot more companies which are smaller in nature in terms of the market cap or the size, and they will do far more better businesses and niches. Today, you have a very significantly headwinds where the slowdown in United States will also produce a slowdown in China, because China is a factory for the world, and it will have a lot of implications. So you need to. So in order to find a winner in this whole situation, are going to be individual stocks, not a great sectors. Individual stocks will do far better, and this was something which I had a discussion maybe in November 2022 when I did visited one of the media channels, that you may have a situation where the stock market can remain a flat, but individual stocks will give you a return. So it's going to be a stock pickers market, not the indices markets.
So now, maybe last 5 minutes on Vallum. So what is the positioning of Vallum, and what is the vision of Vallum? How is this differentiated from others? Obviously, everybody promises to create wealth for investors. Everybody tries and aspires to generate alpha. But how is Vallum generating alpha, and where do you see, the guidance for investors going forward, given the current environment of interest rates, and how is your portfolio positioned in that context?
So as I mentioned to you, we from a research point of view, we do a blend of top down and a bottom up while making those investment calls. These cycles helps us in positioning our companies, because we run a very concentrated bets, 20 bets max in a portfolio. So the bets are very concentrated in the process. So these understanding of the headwinds and the tailwinds of the sector do help us in sizing our portfolios. There's nothing at a half or 1% for our portfolio investments opportunities. And as I mentioned and alluded, that next maybe a year and a half or 18 months time frame are going to be purely a stock picker markets. It's not going to produce very outlier returns from an index perspective also. And our vision for Vallum has been, we want to produce a superlative returns, risk adjusted returns for our investors. And I did mention in one of my slides that when you do this business cycle investing, one of the benefits when you get these rights is that you experience a lower drawdown in that process before you realize its returns from those investment ideas, because you are buying an unpopular investment ideas. You're not into those crowded trades in the process, so you are not held hostage to the shrinkages of the multiples, which ideally do happen when you do this momentum kind of investings. So that's what our winning streak has been. How we are different, I'm sure everyone works very hard. Most of the people who have put their life and energies on those alternative investment side are working very hard, and every style has got his own day and time and to shine. So we just aspire to do what we have done, doing over a period of time to do better.
Manish, I think it has been really pleasure, conversing with you. We had actually promised for 45 minutes, but we are past 50 minutes because, the discussion went on. So, before we kind of come to conclusion, would you like to give your remarks or views on the, the Adani story going on? Because there are a couple of questions in the chat regarding the same, because you are an experienced fund manager and you must have seen, such debacles in the past as well. How do you see it at the present?
Bit difficult. What all is there in the public notice? I'm also privy to that. Nothing much I can add that what is a hearsay here on the Adani story. One thing is sure, I have visited Adani port, and I can tell you that many of these infrastructure assets are fantastic in nature. Now the gap always happens in life is how do you put a value to the asset what you are seeing, or asset what you are is available to you, and that's where the science and art does an intersection, or something ends and science ends and art starts, or art ends and science starts. So that is up to investors to decide. I can tell you, I think this Adani, the ripple effect of Adani is for all investors to do introspect that you can't make money in a momentum kind of style of investing, or you should have a very serious idea about owning those assets for a long period of time. When you are doing investing, the first question you have to ask is to yourself is that the investing is like owning a fraction of the business, and are you happy to own this fraction of that business or not? And secondly, it comes to the value what you want to put to that asset or not. And that's where the confusion happens in most of the investors' mind, and maybe where the money is lost and where the money is made, because you have other attributes also. Because if you are trying to buy a fraction of the business, you want to buy a character of the management, you want to buy the character of the ecosystem in the process. And if you like that, maybe you have any investor would do his own due diligences or will have his own mind. But I can tell you that uh, everyone on this side, please don't look at equity as a linear returns. Maybe the investor, like guys, would like us, guys like us would like to produce linear returns, but it's so difficult because the equity by design is not designed for linear returns. So you have a patches which will do very well, and you have patches which will do not do well. And you have to select a style what is closest to you when you're selecting a manager or invest or in an investing company.
Right, Manish, I think this has been really insightful. Great learnings. We want to continue this every Friday, and thank you so much for joining us today. And thank you, everyone, for giving us your precious time. Wish you a very happy weekend. And I again, kind of urge all those serious investors who would like to kind of take serious investment decisions to kindly visit our platform PMS AIF World and book an appointment with us. We are very wise, very experienced people in the space of alternatives. We have deep dived this space analytically across not just returns but risk matrices also. So nobody in the industry would have as much in-depth data as we would have. And that's the nature of our positioning of our business model. We help you make well-informed investment decisions. So you're most welcome to kind of come and converse with us, and you will be kind of quite satisfied with all your requirements. Thank you, everyone, for giving us your time today. And thank you, Manish, once again.
Thank you, Kamal, for hosting us. Thanks a lot, and see you again.
My pleasure.